Now, 115 JB, the next part of 115 JB. Yes, if benefit is given by a foreign tax rate, to that extent the benefit is removed from MAT. Exactly. Now, 115 JB, we have almost completed except for INDAS companies. This is again a very big area. For that, you should know basics of INDAS. I only believe that you know the basics of INDAS. In INDAS, if you go to statement of profit and loss, you will prepare PAT. Then after PAT, you have got one special item called as other comprehensive income. After PAT, you have got a special item, that is other comprehensive income. Now, this INDAS compliant companies, that is for whom the INDAS is applicable, they would have got this PAT and other comprehensive income. The starting point for them will also be only PAT. The starting point will also be only PAT. So whatever 15 buckets of adjustment that we do, that will continue to be applicable for INDAS companies. Because the starting point is PAT, that will continue to be applicable. In other words, what we need to understand is, whatever we have got for other comprehensive income, only those items are what we need to understand now. Other comprehensive income, only those items we need to understand. This other comprehensive income has got two parts. Other comprehensive income has got two parts. Items that will not be reclassified to P&L. Items that would be reclassified to P&L. That means, in this case, in future it would be taken to P&L. In this case, in the future it will not be taken to P&L. Items that will not be reclassified to P&L account. Item that would be reclassified to P&L account. That means in future it will be taken to P&L. Again, let's understand. It has got two parts: PAT and other comprehensive income. Then, maybe, give me 1 second. I'm trying to, like, you have got PAT, then you have got other comprehensive income, then total comprehensive income. So the starting point will continue to be PAT, and you will do those 15 buckets of adjustments that we discussed. That will continue. Other comprehensive income has got two parts: item that will not be reclassified to P&L account, item that will be reclassified to P&L account. Any item that would be reclassified to P&L account, you will ignore, because anyway in future it will be reclassified to P&L. Because it is going to be reclassified to P&L in future you will be paying tax, because the starting point is PAT. Because the starting point is PAT, items that will be reclassified to P&L account will be completely ignored for the purpose of MAT. Items that will not be reclassified to P&L account alone, we have to now consider and see how it has to be taken for the purpose of computing book profits. For the purpose of computing book profits, how we have to do that. Right? Now, this is what is very, very critical. I'll come back how it has to be done. Again, quickly. PAT, you will do those 15 bucket of adjustment. And after you do those 15 bucket of adjustment, you would go to other comprehensive income. In the other comprehensive income, you have got two parts: Other comprehensive income, you have got two parts. Items that will not be reclassified to P&L account, items that will be reclassified to P&L account. Whatever that would be reclassified to P&L account, you will ignore for MAT purpose, because anyway in future it would be taken to P&L. Items that will not be reclassified to P&L account, that alone we have to do it for MAT. That alone we have to do it for MAT. One item, one bucket of adjustment that we have to now do. Maybe we can call it as the 16th bucket, which is applicable for INDAS. In OCI, whatever item that will be reclassified to P&L account, that we have to do. Next step. This company was following IGAP. Now it is getting converted into INDAS. IGAP company is now getting converted into INDAS. IGAP company is now getting converted into INDAS. You would have all seen this in INDAS 101. We call it as transitional adjustment. That means on the date of transition or on the date of convergence from IGAP to INDAS, you will get some adjustment. This will impact your reserves. You have to take it to other equity, because it is going to impact your reserves. For that also you will have MAT. This is one type. Convergence adjustment is one type. Then you will have annual adjustment. Annual adjustment keeps repeating every year. Annual adjustment will be arising only in case of other comprehensive income that would be reclassified, that will not be reclassified to P&L account. Only that item which will not be reclassified to P&L account will be taken in other comprehensive income, will be taken for MAT. Now, so two types of adjustment. So there are 17 buckets for INDAS combined companies. 15 buckets that we have already discussed. 16th bucket is OCI, that will be not be reclassified to P&L account. Then transitional adjustment on the convergence rate. So we will take the trial balance, which is in IGAP, convert into INDAS. On the date of convergence, you will have various kind of adjustments that you will do. Those adjustments, how you have to do MAT. These are the two things that you need to understand. I hope you are all able to understand the basics. So we'll stop here for the day. Too much you have already discussed. So INDAS, it's like another 40 minutes of discussion. So when we meet up again tomorrow, we'll talk about this. Now we were discussing about INDAS. We just started with the INDAS relating to MAT. How it has to be done. What are the various things that we have to do? As we discussed, 15 buckets of adjustment will continue. Then 2 adjustment. The first is annual adjustment. Annual adjustment. So we have items that would be reclassified to P&L, items that will not be reclassified to P&L. Anything that would be reclassified to P&L. Anyway, in future it would be reclassified to P&L, because in future it has to be reclassified. You will not consider now. So annual adjustment would be only for items that would not be reclassified to P&L. Items that will not be reclassified to P&L. This is in OCI. We are talking about OCI. Items that will not be reclassified to P&L. Now, in this, you have to understand 2 points. First, add any amount that is credited to P&L account. Add any amount that is credited to OCI, not P&L. Add any amount that is credited to OCI in items that would not be reclassified to P&L account. That would not be reclassified to P&L account. Next, less items debited to OCI. Less items debited to OCI. Now, so any item that is credited to OCI will be added because it is an income, we will be adding. Any item that is debited to OCI because it is an expenditure, it has to be reduced. Now, in this context, what we need to understand is, friends, you need to ensure that there are adjustments which are in OCI you should not do. Adjustments in OCI which you should not do. First, if in OCI, if there is a revaluation of any asset as per INDAS 16 or 38. INDAS 16 is for tangible asset, property, plant and equipment. INDAS 38 is for intangible asset. So any item, any revaluation that you have got as per INDAS 16 and INDAS 38, you will not do. It might be in items that will not be reclassified to P&L account. Item that will not be reclassified to P&L account, don't. If it is a revaluation, you will not. You will ignore that revaluation. You will ignore that revaluation. Similarly, the next item that would be ignored. The next item that would be ignored is gains or losses. Gains or losses that arises on account of fair valuation of equity instrument. Fair valuation of equity instrument as given in INDAS 109. As given in INDAS 109. Gains or losses that arises on account of fair valuation of equity investment or equity shares. If it is as per INDAS 109, again it has to be ignored. Now in OCI, item that would be reclassified to P&L account, ignore, don't consider. Item that would not be reclassified to P&L account, you will generally consider. However, two items would be ignored. Revaluation of assets, fair valuation of equity instruments. These two would be ignored. These two would be ignored. Every other item that you have got, in item that would not be reclassified to P&L account, that is appearing in OCI. If it is debited, it has to be reduced. If it is credited, you will add. Debit has to be reduced. Credit will be added. Now, at a later point in time, assuming these assets are sold, these assets are either the equity shares or the fixed assets are sold. Then at the time of sales, if it is a loss, at the time of sales, you are ending up having a loss, then book profit has to be decreased. Book profit has to be decreased. If you end up having a profit, then book profit has to be increased. Book profit has to be increased. This profit or loss, how you would be computing would be selling price minus cost price. In the books, you would have taken selling price minus fair valuation. No, you will not do. You will do selling price minus cost price. Selling price minus cost price. Whatever you get, that would be considered. So generally, items that will not be reclassified to P&L account will be not be reclassified, will be taken for MAT computation. However, revaluation of assets and fair valuation of equity instruments will be ignored. When these assets are sold, then if it is a loss, you will decrease. If it is a profit, you will add. How do you compute loss or profit? Will be selling price minus cost price. Selling price minus cost price will be. Now, in case of demerger, as per INDAS, in case of demerger, as per INDAS 10, Non-cash assets, if it is given to the shareholders in a demerger, it could be either debited or credited to P&L. Non-cash assets are distributed to the shareholder. As per INDAS, it might be debited or credited to P&L account. If it is debited, you will add. If it is credited, you will reduce. That means at the time of distribution of non-cash assets, any profit or loss that you have got should not be considered. It is in P&L. This profit or loss that you have got will be in P&L. Now I should not consider the profit or loss. Loss would be debited. I should not consider, therefore I have to add back the loss. Gain would be credited. I should not credit, therefore it has to be reduced. So there are broadly 4 annual adjustments you have got. OCA that will not be reclassified to P&L account, add credit items, less debit items. However, 2 items should not be included. Non-cash distribution in India is, if it is credited to P&L, you will reduce. If it is debited to P&L, you will add back. This is what you have got for annual adjustment. This is what you have got for annual adjustment. Now, quickly seeing the notes that we have got.
Sir,
Yeah,
sir, can you hear me? Sir, in case of selling price minus cost price, will we give the impact of depreciation, or how will it work?
Depreciation would be given, of course.
Okay.
Computation of book profits for INDAS compliant companies. There are 2 types of adjustment in the book profits due to adoption of INDAS: annual adjustment, transitional adjustment. Computation of INDAS for annual adjustment. For INDAS compliant companies, the following adjustment and additional adjustment. Following additional, that means that 15 buckets that we were doing will continue. Increased by the amount credited to other comprehensive income in statement of P&L under the head item that will not be reclassified to P&L. Decreased by the amount debited to other comprehensive income in statement of profit and loss under the item that will not be reclassified. Increased by the amount debited to statement of profit and loss on distribution of non-cash assets to shareholders in demerger as per INDAS 10. Decreased by the amount credited. Revaluation of investments and fixed assets. No adjustment should be made where the amount credited or debited to other comprehensive income under items that will not be reclassified to P&L account in respect of revaluation surplus in accordance with INDAS 16 or INDAS 38. Gains or losses from investment in equity instrument designated at fair value through other comprehensive income as per INDAS 109. The book profit shall be increased by the amount credited to other comprehensive income for revaluation or designation of equity instrument at fair value in the year in which such asset or investment is retired, disposed, sold, or otherwise transferred. The book profit shall be decreased by the amount debited to other comprehensive income only in their sales. Treatment of other comprehensive income in a nutshell. In the table we are just talking about. Changes in revaluation, surplus or tangible and intangible to be included only at the time of transfer. Gains or losses of equity instrument designated at fair value to be included only at the time of transfer. Remeasurement of defined plan liabilities included as and when it arises. Any other item included in book profit as and when it arises. This is just an extra point. Doesn't matter. In case of resulting company, the properties and liabilities of the undertaking received are recorded not at book value, then such value shall be ignored for purpose of MAT computation. For the amounts under item that will be reclassified to P&L account in other comprehensive income shall be ignored. Now we are talking about transitional adjustment. We just had a little bit of understanding on the meaning of transitional adjustment when we were discussing yesterday. Meaning of transitional adjustment when we were discussing yesterday. Now, transitional adjustment. Whatever transitional adjustment that we have got, whatever transitional adjustment that we have got. Please understand, friends, this transitional adjustment, if it is a profit, you will add to book profits. Transitional adjustment, if it is a profit. If it is a loss, it would be reduced from book profit. You will not add the entire amount. You will add only 1/5. Similarly, reduce only 1/5. 1/5 you will be done for a period of 5 years. So the transitional profit or loss will be taken over a period of 5 years. Over a period of 5 years. Transitional adjustment means amount adjusted in other equity. You should all be knowing what is the meaning of other equity. Amount adjusted in other equity, but will not include anything adjusted in capital reserve and securities premium reserve. You will not consider the adjustment in capital reserve or securities premium reserve. Any other reserve that you have got, it will all be considered. Any other reserve that you have got, it will all be considered. So transitional adjustment means adjustment done in other equity other than capital reserve and securities premium. And when you compute this transitional reserve, transitional adjustment, the following adjustment will be ignored. Following adjustment should not be considered. Amount adjusted in other comprehensive income under items that would be reclassified to P&L account. Transitional amount adjusted in item that would be reclassified to P&L account has to be ignored. Second, revaluation surplus for tangible or intangible assets. Revaluation surplus for tangible or intangible assets. Third, fair valuation of equity instruments. These three you will not even consider under the annual adjustment. You will not even consider under the annual adjustment. Same thing even in the transitional adjustment. You should not consider. Transitional adjustment you should not consider. Then three more items that you will not consider for transitional adjustment. Fourth, adjustment on account of difference in foreign operations. I have got a foreign operations for the translational difference from foreign country to foreign currency to Indian currency will have translational difference. The translational difference has to be again ignored. You will not consider. Then fifth, adjustments to property, plant and equipment. Adjustments to property, plant and equipment which are recorded at fair value. Property, plant and equipment which are recorded at fair value on the convergence date. This is revaluation. This is fair valuation. Whether it is a revaluation or fair valuation, it has to be ignored. Sixth and the final one. Adjustments to investment in subsidiary, joint venture or associate which are recorded again fair value. This is any equity instrument fair valuation. This is specifically any investment in subsidiary, joint venture or associates which are recorded at fair value that are considered as deemed cost. Right up. Now, because of these adjustment, if there is a change in the deferred tax, that also has to be ignored. Any deferred tax adjustment on account of INDAS transition, that also has to be ignored. deferred tax adjustment on account of INDAS has to be again ignored. Preference shares as per INDAS can be classified as financial liability. Preference shares can be classified as financial liability. I distribute dividends on the preference shares, but as per financial liability, if it is as INDAS, you will call it as interest. Recollect our discussion under the 15 buckets. One of the bucket was dividends paid or proposed. It has to be ignored. Dividends paid or proposed has to be ignored. If preference shares are classified as financial liability, then as per INDAS, you might call it as interest. For the purpose of computation of MAT, you call it as whatever you want, whether dividend or interest, you have to add. It will be a positive adjustment. For calculation of MAT, the amount has to be increased by dividend or interest or preference shares, whatever it might be presented in financial statement. In financial statements, we are not bothered about how it is presented. It has to be added back. Right. These are the things that we need to understand. Quickly seeing the notes. In case of INDAS complaint company, the book profit shall be increased or decreased by 1/5 of the transition amount for a period of 5 years. Transition amount means adjustment in other equity, excluding capital reserve and securities premium on convergence date, and excludes the following: amount adjusted in other comprehensive income on the convergence date, which shall be reclassified to P&L account; surplus on account of fixed asset; gain or losses from investment in equity instruments; adjustments relating to items of property, plant and equipment; adjustments relating to subsidiary; adjustments to cumulative transaction of foreign operations. Convergence date means the first day of INDAS reporting. These adjustments recorded in other comprehensive income referred and which should be reclassified to P&L account shall be included in the year which they are reclassified. Therefore, they are excluded. We know this. The amount of revaluation or designation shall be included or in the year which it is retired. We also know this. Depreciation shall be ignored on revaluation. We all know this. This is the extra note. That's all. Any deferred tax adjustment recorded in the reserves and surplus shall also be ignored. For the purpose of MAT, profit or transition amount shall be increased by dividend or interest on preference shares, whether presented as interest or dividend. Hope you are all able to understand this discussion.
So when we say on top that it excludes the following, there will be no adjustment that will be made to it, right?
That means when you take the, when you find out the transition amount, you will not consider these items.
Right. Okay. Understood.
Hope you are able to understand this. We'll as usual do few problems here. We will start with comparatively a simpler problem. Problem number 6 that we do, which is in page number 14. Viraj Exports Limited. But it's in 2 pages. As usual, take up 5 minutes of time. Please do, then we'll discuss. So we have got profit as given 95 lakhs and income tax 5 lakhs. Interest is also considered as tax. Interest is also considered as tax. Then sales tax liability, you will not have any kind of adjustment. Sales tax liability, you will not have any kind of adjustment. Then depreciation, you will add the full depreciation and then reduce whatever depreciation you have got other than revaluation. So we will add full depreciation. Then after that, interest unpaid, no adjustment. Interest unpaid is again a 43B adjustment. You will not do for MAT. You will not do for MAT. It's only a 43B adjustment. Then after interest, the next one that we have got, reserves. Any reserve created by debiting P&L account, it will be a positive adjustment. Any reserve created, you will have a positive adjustment. After that, next one, penalty. Only under normal provisions you will have adjustment. You will not have any kind of adjustment. For the purpose of MAT, you will not have any kind of adjustment. The adjustment would be applicable only under the normal provisions, not for the purpose of MAT. Then after that, the next, dividends. Dividends are taxable. Therefore, no adjustment would be done for the dividends because it is taxable in India. So you will not have any kind of adjustment. Long-term profit from rural agriculture land. Rural agriculture land is not exempt. It is only excluded from 2 subsection 14. It is not exempt. Please understand. It is only excluded from 2 subsection 14. Therefore, you will continue to have that. In your book profits. That means no exclusion. Profit from SCC. Profit from SCC is under section 10AA, not section 10. It is under section 10AA. Therefore, you will not again exclude. You will not exclude. Net agriculture income. Net agriculture income expenditure has already been reduced. You will now less because it is exempt under section 10. Net agriculture income is exempt under section 10. Therefore, you will reduce royalty. So the problem tells you at the end that this company is registered under section 115 BBF. This company that you have got is registered under section 115 BBF. Therefore, any royalty that you have got, it has to be a negative adjustment, 40 lakhs. Whatever royalty we have got, it has to be a negative adjustment, 40 lakhs. Then depreciation, less depreciation. Problem gives you depreciation as per income tax act. Not at all relevant. It has to be ignored. It's not at all to be considered. Then less depreciation other than revaluation. Other than revaluation. Now depreciation that you have got in this problem is total depreciation you have got is 4 lakhs. So 4 lakhs minus 1,90,000. 1,90,000. So the amount that would be eligible for deduction would be 2,10,000. Amount that would be eligible for deduction would be 2,10,000. Out of 4 lakhs, 1,90,000 is on account of revaluation. You will not consider. Then interest on borrowed capital. It doesn't fall in the 15 buckets. Therefore, no adjustment. Then note. Brought forward loss, unabsorbed depreciation, whichever is lower. So unabsorbed depreciation, the problem gives you 4,10,000. Brought forward loss, including the unabsorbed depreciation, is 4,70,000. So you should take brought forward loss excluding the unabsorbed depreciation, which is 60,000. 4,70,000 minus 4,10,000, which is 60,000. Lower of these two, brought forward loss or unabsorbed depreciation, whichever is lower, will be having a negative adjustment. Whichever is lower. Will be having a negative adjustment. Now, quickly, if you see, these are the various kind of adjustments. These are the various adjustments that we have got for this particular problem. Then after that, what you will get would be book profits. So you will have to compute the book profits. You will have to compute the book profits. Then MAT at the rate of 15%, 56 lakh 60,000 multiply by 15%, 56 lakh 60,000 multiply by 15%. Then add cess at the rate of 4%. This multiply by 4%. Total tax payable will be 8,49,000 plus 33,960. 8,49,000 plus 33,960. So you'll have a total tax of 882,960. The last part is very simple. Multiply by 15%. Now computing till book profit is what you have to do very, very carefully. Please let me know if at all you have got doubts. Otherwise, let's go on to problem number 7.
Sir?
Now, while doing adjustments, book profit adjustment 15 buckets, one of the item is exempt income. You will have a negative adjustment. Exempt income, there will be a negative adjustment. Right? Now, long-term capital gain from rural agriculture land, it is not exempt under section 10. It is not considered as capital asset. Because it is not considered as capital asset, no capital gains. So section 2 subsection 14 excludes this as capital asset, therefore no capital gains. So 214 and all should not be considered for MAT purpose. Because it is not covered under section 10, you will continue to, this is not covered under section 10, it will continue to be in MAT. It will continue to be taxable. That means there should not be adjustment. It's already credited to P&L account. You should not have any adjustment for this. Right?
And then
Right. Let's get this started. Say, sir, Zenith Formulations Limited, an Indian company engaged in pharmaceutical formulations, adopted INDAS on 1st April 2019. Following information was furnished. The book profit after all adjustment of section 15 JB, it should be JB, amounted to 52.26 lakhs, except for brought forward loss. Brought forward loss you have got, unabsorbed depreciation you have got. Generally, we will take whichever is lower. Item that would be reclassified to P&L account, it has to be completely ignored. Item that will not be reclassified to P&L account. Changes in fair value of equity instrument, you will ignore. Cash flow hedge credit has to be added. This deferred cost of hedging debit has to be reduced. Then share of other comprehensive income of other associates credit has to be added. Remeasurement of post-employment benefits obligation credit has to be added. Revaluation surplus has to be ignored. The transition amount on the convergence state stood at 52.50 lakhs, including 8 lakhs in capital reserve, adjustment of 4.5 lakhs relating to transition difference of foreign operations. So 52.5, any adjustment to capital reserve has to be ignored, 4.5 also has to be ignored. NCLT has accepted under section 7 of Insolvency Bankruptcy Code. Now, because it has been accepted, you will reduce both unabsorbed depreciation as well as business loss. Compute MAT. Assuming the total income tax as per the normal provision works out to 9.2 lakhs. Compute the tax rate and also understand and also tell us which period it can be carried forward. Let's go ahead. Let me know if at all you are not able to see the Excel. So we are all able to see the Excel. Profits as given. Profit as given. The problem gives you profit of 52,26,000. 52,26,000. Then less brought forward loss, less unabsorbed depreciation. Unabsorbed depreciation is 1.75 lakhs plus 2.2 lakhs. 1,75,000 plus 2,20,000 will give you 3,95,000. Business loss would be 4,60,000 plus 4,90,000 minus 3,95,000. That is assumed business loss includes unabsorbed depreciation. So it will be 4,60,000 plus 4,90,000 minus 3,95,000. This is on the assumption that business loss includes unabsorbed depreciation. So it is business loss other than unabsorbed depreciation or unabsorbed depreciation, whichever is lower. Then items in OCE reclassified to P&L. Reclassified to P&L, it has to be good. Please. This has to be reduced. You have to reduce these two. Then item that would be reclassified to P&L account has to be ignored. Item that would not be reclassified to P&L account, you will consider that under that first step. Not reclassified to P&L account. Under that, changes in fair value. Changes in fair value of equity instrument, ignore. Fair valuation of equity instrument, ignore. Then deferred gains on cash flow hedge. Deferred gains on cash flow hedge. It's an item of credit, therefore it has to be added. 7,25,000. 7,25,000. Deferred cost on hedge. It is item of debit, therefore it has to be reduced. 4,10,000. Share of OCI of other associates. OCI of other associates, item of credit, so you have to add 3,20,000. Item of credit, so it has to be added 3,20,000. Then remeasurement of post-employment benefit plans. Remeasurement of post-employment item of credit, so it has to be added 4,45,000. Revaluation assets has to be ignored. Revaluation of assets have to be ignored. You cannot consider that, it has to be ignored. Then transitional adjustment. Take it as open. Open. Under the term, total adjustment. Here. Total adjustment as given 52,50,000. Total adjustment as given is 52,50,000. Less adjusted to capital reserve. Less adjusted to capital reserve is 8 lakhs. So anything that is adjusted to capital reserve should not be considered. Therefore, it has to be ignored. 8 lakhs. Less adjustment on foreign operations. Adjustment on foreign operations again should not be included. So you have to again reduce balance over values. 52 lakh 50,000 minus 8 lakhs minus 4 lakh 50,000 will end up having 40 lakhs. 1/5 of about 40 lakhs divided by 5 gives you 8 lakhs. 40 lakhs divided by 5, 8 lakhs. So transition adjustment problem very clearly tells you transition adjustment credit. So if it is credit, you have to add. Now book profits. Book profits. You have to find out the profits. 'MAT at the rate of 15%. 9,23,400. Cess at the rate of 4%. Total cess at the rate of 4%. Total tax 9,60,336. 9,60,336. Please let me know in case you have got doubts. The problem is not yet completed. It says normal tax. You have to always round off this. Round off to the nearest 10 digit. 9,60,340. Normal tax 9,20,000. MAT credit can be carried forward for 15 years. It can be carried forward for 15 years. This is what you have got for problem number 7. Please let me know if at all you have got doubts. Let's go ahead and understand problem number 8. Hope you are all able to see my Excel here. Profit has given 20 crores. Profit has given is 20 crores. Add depreciation. Add depreciation 18 crores. Full depreciation has to be first added. This depreciation other than revaluation. So anything relating to revaluation has to be ignored. Other depreciation you have to consider. So it is 18 crores minus 3 crores. That will be 15 crores. 18 crores minus 3 crores will be 15 crores. It's a negative adjustment. Then interest. Interest for TDS. Any interest, it has to be added back. Any interest under the income tax act, you have to add back 20 lakhs. Any interest has to plus share of AOP income. AOP income is not taxable, so that has to be excluded. Correspondingly, will also exclude any expenses. But in this problem, we have got only share of AOP, therefore only that has to be excluded. Then,
Sir?
yeah.
So in this thing, share of AOP, it is getting taxed at MMR. So as per the note, as per our notes, it says only when no tax is paid on AOP, the share portion we don't take it. Right?
The AOP pays tax at MMR. That means in the hands of company it is exempt. AOP pays the tax at MMR. So if you carefully see, it says AOP is paying the tax at MMR.
Okay.
Now,
So if the
back,
AOP does not pay tax, then how is it considered, sir?
we will see in the assessment of AOP. We have got a separate discussion as assessment of AOP. Share of
No, with
AOP,
reference to MAT, I'm asking, sir.
yeah, that's what. So share of assessee's income of an AOP on which tax is not payable as per section 86. If a company is a member in an AOP, company is a member in an AOP, then
Okay.
AOP will mandatorily pay tax only at MMR. It doesn't have an option, it has to pay only at MMR.
Yes, understood. Understood.
So if AOP doesn't pay tax at MMR, will not arise for MAT provisions.
Okay, done. Done. Thank you, sir. Thank you. Thank you.
No problem. Right. So now going back to the Excel, share of AOP. The moment company is member in an AOP, it is exempt in the hands of company. Then amount withdrawn from reserve plus amount withdrawn from revaluation reserve. Amount withdrawn from revaluation reserve, you will reduce only to the extent of depreciation on revalued asset. You will reduce only to the extent of depreciation on the revalued asset to the extent of 3 crores. Hope you are able to understand this, sir. Plus brought forward loss plus unabsorbed depreciation accepted by IBC. Both has to be reduced. Accepted by IBC, both has to be reduced. Right. So first, you will have 3 crores as unabsorbed depreciation. 8 minus 3, 5 crores as business loss. Business loss. Assume the business loss includes unabsorbed depreciation. Assume business loss includes unabsorbed depreciation. Then other comprehensive income under the revaluation. Under the revaluation, it has to be ignored. Then OCI remeasurement. Remeasurement. It says it is credited, therefore it has to be added. 50 lakhs you will add. Remeasurement. 50 lakhs have to be added. Then add transition adjustment. Transition adjustment is total is 5 crores. 5 crores. From there 50 lakhs have to be reduced. From there 50 lakhs have to be reduced. You will get 4 crore 50 lakhs. You will be eligible to claim 1/5 of that, which is 90 lakhs. 1/5 of total other than capital reserve. 1/5 of total other than capital reserve. So what you get after this will be profits. 13 crore 10 lakhs. What you get would be the book profits. Please let me know in case you have got doubts till this. Right. MAT at the rate of 15%. 13 crore 15 lakhs multiply by 15% will give you 1 crore 96 lakh 50,000. Add surcharge at the rate of 12%. If the total income is more than 10 crores, surcharge would be at the rate of 12%. Surcharge would be at the rate of 12%. Subtotal. Then cess at the rate of 4%. Total tax 2 crore 20 lakh 8,000 plus 8,80,320 will give you 2 crore 28,88,320. Then tax under normal provision. Sir. Problem tells you 73 lakhs. MAT credit will therefore be the difference between these two. 2 crore 28,88,320 minus 73 lakhs. You will end up having 1 crore 55,88,320. So this computation is not bigger. It's only till finding out this 13 crore 10 lakhs. Please let me know if at all you have got doubts. If you don't have, go to problem number 4. Problem number 4 is a combination of normal provisions and MAT provisions.
Good.
Right. It says the profit as per the PML account of Harsha Limited for the year ended 31st March 2022 is rupees 14 lakh after making the following adjustments. Arrived at after making the following adjustments. Provision for loss of subsidy. Interest we have got. Small this number has to be changed here. Number has to be changed here. Provision for income tax, expenses on purchase and sale, income from UTA, depreciation, long-term capital gain on which STT has been paid at the name of purchase as well as sales. Depreciation includes 1,50,000. Depreciation allowable as per income tax is 2,80,000. Then we have got loss including the depreciation as per the books as per income tax. Then revaluation reserve 1,50,000 as per OCI. You are required to compute the total income in the treatment, examine the applicability of 115 JB, book profits as well as the tax paid if any to be carried forward. Right. Let's go ahead. Problem number 9. Profit. Hope you are able to see my Excel. Particulars as per normal provisions. NP we call it as normal provisions. Reasons. MAT. Again, reasons. This reason is for MAT. Why are we doing like this? Right.
But your Excel is not visible.
Can you let me know if it is visible now? Again, shared.
Yes, sir.
Okay. Profit as per P&L. So you have particulars. NP is normal provisions, reasons, MAT, and reasons. Profit as per P&L 14,25,000. 14,25,000. Same thing we have got for MAT also 14,25,000. That cannot be changed. The profit as per P&L. First, provision for subsidiary loss. Both the cases it has to be added up. Both the cases it has to be added 70,000. 70,000. This is the reasons for normal provisions. This is the reasons for MAT. Normal provisions, not for business. It's not for your business purpose, therefore it has to be added up. And ideally, these numbers were all interest paid to the buyers on 28/2/2021. It should have 22. It should have been for the advance on which tax has been deducted in May 2021 and deposited. Because of the changes in the numbers, we will say interest allowed as deduction. TDS deducted. TDS deducted and paid. Therefore, it is allowed as deduction. Provision for tax. Provision for tax. PFT is provision for tax. 1,05,000. Section 40. Section 48. 48. Here
Sir,
also.
with,
Yeah.
sir, with respect to interest, if the dates were correct,
Dates were all
then
changed, then it would have been disallowed. But because I don't want to change the dates now, because it's already given. If it was changed dates, then it should be disallowed ideally.
but in case of MAT, there will be no adjustment.
Yeah, math there cannot be adjustment. That's why I didn't give anything. Math I did not give you a reason at all.
Okay, understood. Okay.
Then expenses for shares. Expenses for shares 15,000. Not for business. It is for capitals. You say not for PGBP. Or capital gains. So when you compute capital gains, it will be no heads of income. Therefore, under MAT, you will not make an adjustment. Under MAT, you will not make an adjustment. It will be adjusted only for normal provisions. Then income from UTA. Income from UTA amounting to 75,000. 1 minute. Income from UTA reduce. Less than. The reason taxable as income from other sources. UTA income, it's like a dividend income. Taxable as income from other sources. Here, no heads of income. MAT, there is no heads of income. Depreciation. You will add the entire depreciation that you have got. 3,60,000. 3,60,000. Entire depreciation has to be added. The long-term capital here 3,60,000 will be reduced. Taxable as capital gains. You should tax it as capital gains, not as PGBP. Here again, there is no heads of income, therefore it will continue to be only under this. In case it was a foreign company, then it will be allowed as deduction. If for a foreign company, if a capital gain is taxed at less than 15%, it will be a negative adjustment. It is not a foreign company. Very clearly, it says Harshal Limited. It's an Indian company only. Therefore, it will not be. Then depreciation. As per Income Tax Act, is 2,80,000. As per Income Tax Act, here 3,60,000 minus. You have got 3,60,000 minus 1,50,000. Other than revaluation. Other than depreciation on revaluation. Other than depreciation on revaluation would be allowed as deduction. 2,10,000. Brought forward loss. Note 1. Then mode 2. Let's go to mode 1. Normal provisions. NP is normal provisions. Particulars. Business loss. Unabsorbed depreciation. Business loss. Unabsorbed depreciation. Under that 2015-16, 2016-17, 2017-18. Business loss including depreciation is 4,50,000. So we'll finish up this. 2,50,000 is unabsorbed depreciation. Then next is 1,80,000 and 2,10,000. These are the depreciation. So now business losses 4,50,000 minus unabsorbed depreciation. 4,50,000 minus unabsorbed depreciation. Similarly, 2,80,000 minus unabsorbed depreciation. Then 3,30,000 minus unabsorbed depreciation. So you will have 4,20,000 as a business loss and 6,40,000 as unabsorbed depreciation. 4,20,000 as business loss and 6,40,000 as unabsorbed depreciation. So going this, here you can reduce both. You can reduce both under the normal provisions. You can reduce both. Both can be reduced. Both can be reduced. Now let's go to note 2. Let's go to note 2. Note 2 is for MAT. Note 2 is for MAT. Unabsorbed depreciation is 3 lakhs. This is 2,70,000 for the next year and 3,15,000 for the third year. Now, 5,50,000 minus 3 lakhs. 5,50,000 minus 3 lakhs. Second year is 2,70,000 minus 2,70,000. Third year is 6,65,000 minus 3,15,000. You will do a cumulative lower of the above. This allowed as deduction, which is 6 lakhs. Lower of the above on cumulative basis. We have discussed in detail. It cannot be on year basis. It has to be only on cumulative basis. It has to be only on cumulative basis, not year basis. Now,
Sir,
yeah,
business loss normally can be carried forward for 4 years, right, sir?
8 years.
8 years.
Yeah. Business loss can be carried for 8 years. So it is within that 8-year period, therefore we are doing.
Okay, if not for the 8 years, how do we consider, sir?
So in case for MAT, there is no time limit at all.
Okay.
Normal provision, if it is more than 8 years, you will ignore that. That's all.
Okay.
You will completely ignore. So now, brought forward loss, unabsorbed depreciation. Then, after that, revaluation, surplus. Revaluation should not be considered. Should not be considered. Here also, revaluation should not be considered. So what you get would be PGBP or book profits. PGBP or book profits. 23,20,000. No, sorry. This has to be minus. 2 lakhs or 11,50,000. 2 lakhs or 11,50,000. Hope you are able to understand this until this point in time. Let me know if at all you are not. Then, after that, long-term capital gain, 3,60,000. So you will have a total income 5 lakh plus 3,60,000 will give you, 2 lakh plus 3,60,000 will give you 5,60,000. Now, tax as per MAT. Book profits multiply by 15%. Book profits multiply by 15%. And excess at the rate of 4%. Total tax 1,72,500 plus 6,900. You'll end up having 1,79,400. End up having 1,79,400. Now, tax as per normal provisions. First, long-term capital gain 3 lakh minus 1 lakh. On first 1 lakh, no tax. So it would be 3 lakhs minus 1 lakh multiply by 10%. Multiply by 10%, which should be taxed under section 120. STT paid both on purchase and sales. STT paid both on purchase and sales. Therefore, it would be 26,000. 3,60,000 minus 1 lakh multiply by 10% gives you 26,000. Other income assumed turnover is less than 400 crores. All are in lakhs. Therefore, we are assuming this. We can also assume other way. Multiply by 25% of total. Each multiply by 25% is business income multiply by 25% because long-term capital gain we have taken. Business income multiplied by 25% will be 50,000. Subtotal is 70,000. Add 76,000. Sorry. Add cess at the rate of 4%. 76,000 into 4% gives you 3,040. Total tax will be 76,000 plus 3,040, 79,040. Tax under MAT is more. Therefore, total tax payable will be is 1,79,400. Total tax payable under MAT will be 1,79,400. Then MAT credit would be 1,79,400 minus 79,040. MAT minus normal provisions can be carried forward for 15 years. So you get a MAT credit of 1,00360. You get a MAT credit of 1,00360. So you can get it. Since the long-term capital gain is given, assume that the expenses are allowed as such. So how do you compute capital gains? It is net consideration. It is consideration for transfer minus expenses. Net consideration you will get less all these things. This is how you get. Maybe I will wait for 1 more minute. In case you have got doubts, we'll discuss. Otherwise, we'll proceed. This is what we got for MAT. So we have spent like more than 4 hours, 4.5 hours on this MAT. With only 2 sections that we have. Now, the next thing that we will start is assessment of partnership firm. We hardly have got any time left. We spent most of the time on doing the problems today. But yeah, I'm fine in this type of this one. But it only ensure that you read this MAT at least 2-3 times at your end, because it's all entirely new. It's all entirely new. And as usual, in case you keep getting doubts, or in case you get any doubts, you can always reach out to me.